Welcome back to Talk Tickers. This is the show for the experienced investor, the place we strip away the corporate fluff, ignore the spin, and get right to the numbers.
It's good to be back. And today, we've got an absolute clinic on the docket, pun intended. We're breaking down DaVita Inc., ticker DVA, and their earnings for the fourth quarter of 2025.
And talk about a tape mover. We have to start with the market reaction because, the vibe here was electric. You look at the chart, this thing has been beaten down, right? Down roughly 37% over the last year.
Oh, completely. It was dead money. But after this print hit the wires, a total reversal.
Violent, really.
Violent in the best way for the bulls, yeah. DaVita shares popped about 16% in after-hours trading. We saw it go from a close of $111.19 all the way up to around the $128 handle.
And the volume was there to back it up?
Mm-hmm. We're talking 2.4 million shares. That's more than double their 50-day average.
That is high conviction buying. So the big question we're answering for you today is why? Because on the surface, dialysis is a steady, low growth, let's be honest, kind of a boring business.
Right. But this wasn't just a beat. This felt different. It was like a complete profit power reanchoring.
And it all came down to the guidance.
Exactly. The headline numbers were good. We'll get to those. But the real story, the thing that forced every analyst to rerun their models, was the 2026 guidance. Management proved that their pivot to value-based care is finally, printing real cash.
Okay, so before we get to that guidance shocker, let's just quickly set the table. What did they put on the board in Q4?
So top-line revenue came in at $3.62 billion. That's a beat against consensus by about $120 million.
And that's a 9.9% year-over-year increase. That's a huge number for this industry.
It's a significant outlier.
Yeah.
And the bottom line flowed through. Adjusted EPS earnings per share hit $3.40.
And the street was looking for what, $3.16?
Roughly $3.16, so a solid 0.24 cent. Adjusted operating income for the quarter, $586 million. It was a clean, high-quality quarter.
Clean is good, but clean usually gets you a polite little bump, not a 16% vertical line on the chart. So the guidance, this is the main event.
This is it. The street was sitting there expecting fiscal year 2026 adjusted EPS to be around $12.65. They were braced for headwinds, regulatory fears.
Unusual stuff.
Usual suspects, yeah. Instead, DaVita comes out and guides for a range of $13.60 to $15.
Whoa. Let's just pause on that. The low end of their new guide is almost a full dollar higher than the consensus.
Correct. The midpoint is way higher than even the most bullish expectations. And they backed it up with a free cash flow guide of $1.7 billion to $1.25 billion for 2026. This isn't some accounting trick. It's raw cash.
That's a massive disconnect. So how are they doing it? I was looking at the ops breakdown, and I saw some interesting movement in revenue per treatment, the RPT.
Right. If you're modeling a dialysis company, RPT is your holy grail metric. And in Q4, it accelerated. It was up $12 sequentially from Q3.
$12 per treatment adds up incredibly fast when you're doing millions of treatments. What drove that?
Management was pretty transparent. It was three things. First, just good execution on collections. They resolved some aged receivables.
So collecting money they were already owed.
Exactly. Second, a slight improvement in the private pay insurance mix. And third, seasonality.
The flu season.
The grim reality of healthcare investing, yeah. Flu vac season drives clinic visits and reimbursements.
Right, because for a dialysis patient, the flu can be fatal, so vaccination protocol is strict, and that creates billable events.
You got it. But while the core business is humming, the real structural change is this. For years, they've been telling us, trust us, integrated kidney care IKC is the future.
Right, their value-based care arm. It always felt like a show-me story. Did they finally show us?
They did. I think this is the most critical detail. For the first time, the IKC segment turned a full-year profit, $22 million in adjusted operating income.
That's a watershed moment. It moves IKC from what, an expensive science experiment to an actual scalable earnings layer?
Precisely. And they're not stopping. For 2026, they expect another incremental $20 million in OI growth from IKC.
And what's driving that profitability?
It's better execution on shared savings. The logic is simple. DaVita takes on risk to manage the total health of the patient. If they keep that patient healthy and, crucially, out of the hospital, they share in the savings with the insurance company.
So it's about better outcomes.
It is. Their data shows IKC patients are 35% more likely to start dialysis with permanent access, a fistula, rather than a catheter.
And we should probably unpack that. A catheter is basically a tube hanging out of your chest, high risk of infection.
And infection leads to hospitalization, which is incredibly expensive. DaVita said costs for these prepared patients are 3 times lower in the first 180 days. They're effectively arbitraging the inefficiency of the hospital system.
Arbitrage and inefficiency. I love that. You're taking money that would have been burned in an ER visit and moving it to the bottom line with steady preventative care.
That's the core of value-based care. And DaVita just proved they could do it profitably.
Okay, so IKC is working, but we have to address the bear case. The big cloud hanging over this stock was the expiration of the ACA subsidies.
It was. That was the whole short thesis. The fear was that the expiration would decimate their commercial mix. And, management confirmed it. It's a roughly $40 million headwind in 2026 and about $70 million in 2027.
Okay, so $40 million is a real hit. Why did the stock go up?
Because of what I'm calling the headwind swap. This is where the numbers get really elegant. While the ACA expiration hits them for $40 million, they're simultaneously lapping the costs from that cyber incident in 2025.
Ah, right, the cyber attack. That was a huge drag last year.
Cost them about $45 million in 2025. So look at the math. In 2025, you have a $45 million cyber penalty. In 2026, that penalty vanishes and is replaced by a $40 million ACA penalty.
It's basically a wash. Actually, it's a slight net positive.
Correct. So the market treated it as a huge victory because the risk was quantified and neutralized. They turned this big, open-ended fear into a bounded math problem that just solves to zero.
Incredible. Okay, let's talk volume. You need patients in chairs. What's the outlook there?
It's a bit more muted. U.S. dialysis treatment volume is expected to be flat in 2026 compared to 2025.
Flat's not great. What's the drag?
Well, Q1 2026 is going to be tough. There's a headwind in normalized treatment days, just some calendar weirdness, plus the usual deductible resets.
The Q1 effect.
Right. Deductibles reset, patients suddenly have to pay out of pocket, and some of them, unfortunately, skip treatments. It suppresses volume early in the year.
What about the bigger existential threats? The GLP-1s, Ozempic, is that going to kill the dialysis business?
They touched on it, and they were pretty dismissive of the doom and gloom scenarios. Management sees GLP-1s as a positive for reducing cardiac events in their current population.
So no death of dialysis just yet?
Not yet. They actually have a nice tailwind on the macro side people missed. The 2027 advance notice for Medicare Advantage shows a 6% increase for the end-stage renal disease population.
A 6% rate hike in this environment. That's fantastic.
It's very strong. It shows the government recognizes the cost of caring for these patients and is willing to pay out.
Okay, so solid core ops, IKC is working, headwinds neutralized. What about strategic moves? They announced a deal with Elara Caring. What's the play?
DaVita's investing $200 million for a minority stake in Elara. This is all about pushing kidney care into the home.
So it circles right back to that IKC thesis.
It's the same playbook. Roughly a quarter of DaVita patients already use some kind of home health. By partnering with Elara, they can create a specialized kidney protocol for home care. The goal is simple: reduce hospitalizations.
If you control the home, you control the outcomes. And if you control the outcomes, you keep the shared savings.
Exactly. It reinforces this idea that they're becoming a care management company, not just a clinic operator.
And while they're building for the future, they're buying back the present. The buyback numbers were huge.
Very. They repurchased nearly 13 million shares in 2025 for $1.8 billion.
Wow. And the balance sheet can handle it?
It's healthy. Their leverage is at 3.26x
Yeah.
in their target range. And here's the kicker. They mentioned buying specifically from Berkshire Hathaway.
Right, to keep Berkshire's ownership stake capped below 45%.
Exactly. Knowing Buffett is sitting there capping his stake, but providing liquidity. It's a nice safety net. It effectively puts a floor under the stock.
So, to put this all in context for you, the investor, before this report, DVA was trading on a multiple compression narrative. Fear of policy, fear of GLP-1s.
That narrative is broken. This report changes the story to bounded risk. The ACA hit is quantified and offset. It's manageable.
And execution credibility is restored.
It's a classic beat and raise. The metric you have to watch now is IKC profitability. We need to see that scale without one-time items.
And we have to keep an eye on the flu, bizarrely.
Oddly, yes. Vax rates are at 80%. They want to get to 90%. Higher vax rates mean lower mortality, which means better volume. It's morbid math, but it's a material financial driver.
It's fascinating. Okay, now it's time for everyone's favorite segment. The legal team makes us say this. This is not financial advice. Do your own due diligence. But if you were running a pod right now, what's the trade?
Okay, hear me out. I call this one the home health arbitrage play.
I'm listening.
The setup is this. DaVita is mutating into a logistics and tech-enabled care company with IKC and Elara. But the market still values them like a boring old brick-and-mortar clinic operator.
So the valuation hasn't caught up to the business model transformation.
Exactly. So here's the trade. You go long BVA aggressively. You target the top end of that $15 EPS guide, but, and this is the twist, you pair it with a short on general acute care hospitals.
Ooh, long kidney care, short the hospital. Why?
Because DaVita's entire IKC success is predicated on keeping patients out of the hospital. Their own data says costs are 3 times lower because they avoid admits. Who's on the losing end of that trade?
The hospitals. Those patients are frequent flyers in the ER. They generate a ton of revenue for hospitals.
Exactly. High frequency, high acuity admissions, they fill beds. If DaVita wins, if they successfully manage patients at home, the hospitals lose that reliable revenue stream. It's a value-based care vampire trade.
A value-based care vampire.
DaVita is sucking the revenue right out of the ER and putting it into their own home care bottom line.
That is ruthless. And it's incredibly plausible. The better DaVita gets, the worse the hospitals do on these specific patients. I love it.
It's a direct hedge on the efficiency of the U.S. healthcare system. If the system gets more efficient, DaVita wins, and the bloated legacy providers lose.
And the Elara deal just strengthens that thesis. They're building a moat around the patient's home. The hospital becomes the last resort, not the first stop.
And that's a massive shift in where the profit pool sits.
All right, let's wrap it. Quick recap for everyone.
Revenue and earnings beat. Guidance raised significantly to that $13, $16, $15 EPS range. IKC is finally profitable. And the big, scary ACA headwinds are neutralized by the cyber cost roll-offs.
And the final thought.
DaVita proved the death of dialysis narrative was way premature. They aren't just surviving policy changes, they're actively engineering around them. This is a management team that knows how to play the game.
They're playing chess. Thanks for listening to Talk Tickers. Keep your eyes on the tape.
See you next time.